Let's get to the action, guys. Let's get to our guest today. You guys out there, smash a like if you're enjoying the show.
Rogie Horner. She's head of futures trading over there at Simpler Trading. Rogie, how you doing today?
I always feel like I should have a cape on whenever I hear that intro music. Good to see you guys.
To infinity and beyond.
Okay, Rogie, so let's get right to it. The market shouldn't have rallied yesterday with the bonds and the TLT down, and it did. You get a hot retail sales number. I mean, we're just kind of muddling along here. Give us your macro take, your big picture take on the markets.
We look at what the Federal Reserve wants to do. I think they're making it clearer and clearer that we're going to hold for the remainder of 2023. So what are bonds saying? Why are bonds still in a downtrend? Why are yields still up? And I think it has a lot to do with bond traders saying you're keeping rates too high for too long, because the only time that we have a fully discounted expectation of a quarter point cut is in July of 2024. And that might as well be the year 3000 as far as bonds and equities are concerned. So there's a lot of upset about with how long Powell and company are going to keep rates higher, and bonds are basically reflecting that. But it's hard not to be a bull here. You know, you're talking about retail sales. I love that you guys were talking about the seasonal tendencies. If I step back and look at mid-October, and we are right in that sweet spot where if we're going to have a little bit more volatility and start to move higher into mid to late November, now is the time. And retail is one of them. We should have a really good seasonal type move between now and say Halloween, but it's going to be a rocky move, but overall moving higher seasonally, right? Between now and say mid to late November.
Rogie, it's been the tale of two markets here, though. And, the bulls will say, well, look at, the NASDAQ, and the bears will say, well, look at the IWM. I mean, we have complete separation here. We have some companies in vicious bear markets, and we have some companies that just are sustained bull markets. It's really what we have. Do you think we're going to have an everything rally going into the end of the year where we're coming to the IWM and load up and buy banks and buy beaten down retail names because they are beaten down, the airlines, the cruise lines? Or do you stick with what works? Do you stick with the Apples and the Microsofts and the Googles and the Metas because they continue to just hold up? Where are you going if you're looking to, to obviously participate in an end of the year rally?
I love what you said, because everything about what you said is what is not being talked about in all the other media. We're looking at the pieces of the market. The habit of saying the market is something I'm trying to kick, right? Because you nailed it. There's IWM, that's small cap, that's regional banks. They're doing their own thing, and it ain't pretty. You look at big banks, XLF, impacting the DIA being the number one sector, and it ain't so pretty. So when you look at the Dow and it's having a hard time gaining traction, you look at its number one weighted sector and you say, but of course, that cylinder isn't even firing. Same thing with small cap, same thing with that Russell. Now you shift on over to tech, and I'm going to leave consumer discretionary out, because even though it's a third weighted sector in the NAS, tech and communications, Apple, Microsoft, Meta, Google, and I'll throw Amazon in there, Prime Day. But really, if I take a look at tech's the only one of the sectors that remained above the 200 period exponential moving average. Tech's the only one that survived that little bit of an onslaught at the end of Q3. So I'm bullish, but like you said, we've got to pick our spots. And is this a stock pickers market, sector pickers market? I think it almost always is, except for kind of oasis years like 2020 where everything moves higher. But we've been doing this a long time. We know we've got to look at relative outperformance. The tide can lift most boats right now, and I'm definitely favoring tech. Healthcare is having actually a pretty good move here in Q4, but we got to stay specific to the sectors, which is why all the indices look so wobbly.
Rogie, how do you like block out like everything that's going on right now? I mean, obviously, news sources, the internet. I mean, you're getting everything. Well, some is true, some is not truth. I mean, you're looking at a geopolitical situation that I don't know if it's ever been worse in my entire lifetime here. How do you separate that? I mean, I know you have your technicals and fundamentals and everything, but I mean, it's like you don't want to turn your phone on in the morning. How do you separate the whole entire geopolitical situation from your trading?
When we are trading, we can't be human. We just can't. And I don't mean that and we're machines. Whatever is thumping away in the heart when we hear about what's happening globally, as a trader, it doesn't matter, right? We were told Ukraine was supposed to do certain things to Powell's monetary policy. It did the opposite, right? We hear about what's going on in the Middle East right now. It doesn't, I don't want to make it sound like it doesn't matter, but to the trader in me, it doesn't matter. Crude should be skyrocketing. It's not, right? If we think about where those things map to, I remember being a kid, I was in college and I dealt with my first geopolitical crisis and it was Gulf One. And I thought, oh, for sure, crude's going to move. It ended up being gold. I think gold's moving pretty well right now when we're having this issue. So as hard as it is, we have to compartmentalize. And how do I ignore the news? I think about what makes me money. I look at my family. I look at the people I love. I look at my members and say, how do I take care of them both best? I have to ignore the news. I look at the charts. I look at volume. And I got to remember, I coattail the size and price tells the story. I think price and volume tell the story. So as hard as it is, we got to compartmentalize. And I think, and this is what I love about what you guys do. When I turn the news on, I got to remember those people aren't talking their book. We and the folks listening, we are managing our own money. We are taking our own risk. We are taking our own punches. We are talking our book. And I take that as a sense of pride. When I talk about XLC and XLK, I've got skin in the game. So that's where I also want to make sure I'm listening to people who are talking their book. Tell me you're in the trenches with me. You got the butterflies in your stomach, both and in your heart, but you got to shut the heart off because that's never going to make us money. And that's the way I look at it. And it's hard. You're right. It's hard and it's gut wrenching, but it's our job.
Yeah.
And not everyone can do it.
And I think that also goes into play with logic and what's not logical play and trying to bring logic into the market. If it was like that, I think we'd all be reading just one book on the market. But as you can see, many books behind Raghi. Let's get to the action. Let's talk a little bit about the Fed talk. Of course, the chat's talking about that maybe there could be a rally because of a pause. But I think that's almost like an expectation now, right, in the market. I think that's also why we might have gotten this lift in technology, as it's almost a given that we're maybe one more interest rate hike rate, but I think it's at a pause at this point. Now it's just going to be the focus on the pivot. What are you seeing here from the Fed?
Pause into the end of the year. And this is not my thinking. This is my just simply looking at talking your book. I love Fed fund futures. Those are people who placed a bet in a futures contract and are saying, look, it's more probable that we pause to the remainder of the year rather than get one more quarter point bump. And then there are the same folks that are saying we're not seeing a cut in the picture till July. So if we're going to see a cheap money, yay, the Fed's going to cut rally, that expectation's got to move into at least May before there's any excitement there. However, I think about who are the folks moving money. I'm a retail trader, right? So I'm not going to try to think I'm something that I'm not. However, if I think about the job of people moving money, this end of year is what? They're not dumping positions. I mean, we're going to see our tax loss harvesting, last couple of weeks of December, sure. But this is where weakness gets weaker and strength gets stronger, because I know some folks want to say window dressing doesn't exist. The heck it doesn't. Of course it does. We want to show, right, a good showing. If I'm having to show my statement, if I'm having to show my portfolio to the world, to my clients and say, this is why you stick with me in 2024. These are the holdings you've got. They want to show, hey, you've got the strength in your portfolio. And right now that's tech. So I think tech's going to continue to benefit from that bargain hunting. And healthcare probably is too. Sorry.
It's such a tricky environment. I'm going to piggyback everything you're saying here. But the reason that I wouldn't be bearish tech, and, I don't like the valuations. And I've said, I don't like the Apple valuation. I don't own in my long-term portfolio. But, going into the end of the year, it sets up well. It's what's working. And then I'm going to continue to say is a lot of these companies just don't have debt. So when you don't have a lot of debt, these higher rates aren't impacting you as much. Now, again, your consumer, if they got to finance stuff, that can be a different story. But overall, companies that are burdened with debt are the ones that have really been beaten up in the last 6 to 8 weeks. And the companies that are basically debt-free, Tesla being one of them, which sounds insane to talk about, is holding up relatively well. And people are like, well, I don't get why Tesla can trade 65 times earnings and GM can trade 5 times earnings, and it doesn't make any sense. Well, if you look at the debt load, it does make some sense, but it's not only that. You got to look at, costs and labor costs, and they're trying to renegotiate. And Tesla workers are sitting here at $44 an hour, and, GM and Chrysler and Ford workers want $100 an hour. I mean, there's so many considerations here, but I mean, I just keep separating it here. And I want to be clear because a lot of people think I'm bearish tech. I'm not really bearish tech. I'm bearish, a lot of other stocks here that have a lot of debt. That's what we've been saying it's changed for me in the last few weeks. If I'm short in stocks, it's mostly, we keep doing this exercise. We go on the Benzinga Pro and we look, who's got that? People say, do you like this stock? I was like, well, how much debt do they got? I'm like, no, I don't like the stock right now because we're in a rising rate environment. But I mean, there's a separation happening here, Rocky, and it's a lot to do with how much debt is on those books of these individual companies.
You're absolutely correct in that if I'm looking, so this is where everything you said spot on. I mean, this, you don't need me to agree with you, but I think if I'm taking that information in, and I did, right? And I think we're looking at a time horizon that's probably 6 months, 10 months, 12 months. So to me, it really breaks down to, I don't know what your time horizon is, and that would be a great thing to ask all three of you. When you guys are putting on a trade, what's the time horizon? What's that life cycle of the trade? For me right now, I'm thinking maybe end of the week. I'm thinking, what are the trades that I can put on today, end of the week, maybe end of the month? So my time horizon is a day to maybe 2 weeks at this point. I've taken what you're taking, which is just top notch. But now that's a 6-month conversation to me. That's maybe a daily time frame conversation, a weekly chart conversation that I can hang on to for weeks, if not months. And then I start to think about, why is Tesla benefiting in this environment and GM is not? I go back to weighting. If the NASDAQ's moving higher, whether it wants to or not, the third weighted sector, consumer discretionary, has got to participate in some small way. And our number 2 weighted stock there is Tesla. So I love what you're saying. And then it's going to benefit from a little bit of that rising tide in the NAS.
There's a lot of reasons to not be bearish tech and to be bearish other things. And your ETF, the point you're making is fabulous as well. I mean, it's the reason that the S&P looks so much different than the IWM. It's all about weightings. And I mean, those companies continue to hold up well. So I think like what you're saying, and I agree with you, it's a stock picker's market. And you just can't blindly, we're not in 2020 anymore. I like when you said that too, that you just blindly buy a stock. You had David Portnoy throwing darts and putting 3 letters together and showing you how to make money. And then you just go buy whatever. We're not in Kansas anymore. We're not in that environment anymore. You got to do some research, some homework, but have the technical set up. And what has been outperforming maybe continues just to outperform it. Maybe that's just what this market is.
Raga, I wanted to ask you about all this fuss about the Bitcoin ETF and how that could come into play with Bitcoin and maybe some stocks, some mining stocks. So what do you think about this situation?
I will be frank. I haven't given it a thought until I start to see the way it's reacted to, because let's face it, Mitch, we've been here before and then we're let down. We've been here before. So I'm not jumping the gun. Let it happen. Right. And then let me see how it's been perceived, because I don't want to get caught up in the run up excitement only to kind of buy the rumor, sell the news. And so let's see how it happens, how it's received, and how distracted traders and investors are, because there's a lot of distraction out there right now. And I don't know that the attention's going to be there the way I want it to be. Now, the optimism of the new year, we kind of start with a clean slate. I'm thinking Q1 would be when I'm going to start paying attention. But right now, Q4, I think there's too many other things that we're thinking about. And I just don't think that's front and foremost in people's minds. And let's face it, attention goes, that's where the money flows. And I'm just not seeing it yet.
All right, we've been on the line with Rogi Horner. She heads up the futures division over there at Simpler Trading. Joining us here on Pre-Market Prep. Rogi, always great speaking to you. We'll dial you up again real soon.
Thanks, guys. Great to see you all. Thanks, everyone.
Okay, we got major headlines breaking